All right, so today we're taking a deep dive into what's a pretty interesting situation, I think. It's Arrowhead Pharmaceuticals, ticker ARWR. And here's the thing. This is a company that, on the surface at least, seems to be doing a lot of things right. Promising news flow, big partnerships, but the stock price, well, it just seems to keep facing this downward pressure. So we got a whole bunch of information here that we're going to try to sort through, looking at all sorts of potential causes. I mean, we've got stuff on, like the regular rhythms of the financial calendar. We've got some pretty complex stuff on high frequency trading and short selling. And our goal today is to really try to unpack some of the reasons behind this. Why is this happening?
Yeah, you really hit the nail on the head. I mean, the question you're asking is a really important one. How do these often sort of hidden market dynamics, I mean, you're talking about the patterns we see around month ends, the incredible speed of algorithmic trading, the mechanics of short selling bets, and even Arrowhead's very specific way of funding itself. How do all these things potentially come together and push down the stock price? And here's the really interesting part. All of this is happening while we're seeing some really big institutional investors actually increasing their ownership of the stock. So it's a bit of a head scratcher. It doesn't seem to make sense on the surface.
Yeah, exactly. I mean, we're looking at analyses of how ARWR is trading around those key financial dates. We've got details about who the major institutional shareholders are. We've got some insights into the CEO's preferred funding methods. There are a few different interpretations of what these institutional ownership trends might actually mean. And we've even got information on how hedge funds can sometimes use, pretty aggressive tactics to influence a stock price. And then sort of rounding it all out, we've got some broader perspectives on just the overall market forces that might be at play here. So I think our goal today is not necessarily to arrive at some, final verdict, but rather to kind of explore the potential connections here and to really try to weigh the significance of these different factors. So with all that said, let's just jump right in. Maybe a good place to start is with something that might seem pretty mundane, just background noise almost, but it's something that could actually have some really subtle and persistent effects on the stock price. And that is the financial calendar.
It is fascinating when you think about it. The idea that just the calendar itself, just the regular progression of months, quarters, a year, it can actually create observable patterns in how stocks move. And, academics have been studying these so-called calendar effects for years. So take the month-end effect, for example. We often see slightly higher returns, right around the turn of the month. And one possible explanation for this is that there's simply more money sloshing around in the market, as people's paychecks clear. And then, of course, you've got the quarter-end effect. This is where you often see institutions doing what's called window dressing. And basically what that means is they might buy more of their better performing stocks right before the end of the quarter to make their portfolios look good in their reports to investors. And they got to make the clients happy. And then historically, we've also seen something called the January effect, where smaller company stocks tend to outperform. So these patterns really do exist.
It's funny though, right? Because on the one hand, you've got the efficient market hypothesis, which basically says, look, all known information is already reflected in a stock's price. But then you've got this other idea called the adaptive market hypothesis, which says, well, actually, markets aren't always perfect. And these patterns can kind of merge and fade as investors learn and adapt. It's all very dynamic. So for ARWR, I guess what we should be looking for is there a history of the stock having, stronger returns or higher trading volume around those key calendar points? So the end and beginning of the end of quarters, the start of the year.
Right, exactly. So if we want to test the month-end effect, we would want to look at, the last few days of each month and then the first few days of the following month. And we would compare the average returns during those periods to just the typical average returns for the rest of the month. And if we see a statistically significant increase during those month-end periods, well, then that would suggest that maybe the month-end effect is having some influence on ARWR. And we could do something very similar for quarter ends. Are there noticeable upticks in buying activity that seems to align with, institutions maybe adjusting their portfolios for reporting purposes? Yeah. And then with the year-end effect, particularly that January effect, has ARWR, given its history of being, sometimes a small cap stock, sometimes a mid cap stock, has it typically experienced a lift in January? That's what we'd want to see.
Now, what about option expiration dates? That's usually the third Friday of each month. I mean, could that be a factor injecting some volatility into ARWR's stock price?
Yeah, that's a great question. And yeah, option expiration can definitely create some price swings. So here's the thing. As those expiration dates approach, anybody who's holding options, they've got to make a decision. Do they exercise them? Do they roll them over to a later date? Or do they just let them expire worthless? And at the same time, the firms that sold those options, these are called market makers, they often have to adjust their own holdings in the underlying stock. And they do this to manage their risks. So all this buying and selling that market makers are doing to stay hedged, that can definitely lead to some pretty wild price fluctuations and an increase in trading volume. Now, for some of those really big, heavily traded stocks, they call mega cap stocks, there's actually a phenomenon called the option expiration week effect. Now, ARWR might not always be in that mega cap category with super active options trading, but it's still worth looking into. Does ARWR tend to see any kind of noticeable increase in volatility or trading volume around those third Fridays of the month? That would tell us something.
And then there's this whole other layer of complexity with index rebalancing. So just for context, ARWR is included in a few major indices. So you've got the NASDAQ U Composite, Russell 2000 and 3000. And probably most significantly, it was added to the S&P Small Cap 600 in January of 2025. Now, as I understand it, when a stock gets added to a major index like the S&P 600, all the big investment funds that are tracking that index, they basically have to buy shares of that stock to make sure their holdings match the new index composition. And that can create a lot of demand.
Oh, yeah, absolutely. Index inclusion, that could be a huge driver of buying pressure. So for the Russell indices, the main rebalancing happens once a year in June. But for the S&P Small Cap 600, it's typically done quarterly. And so, ARWR's addition to that Small Cap 600 back in January of 2025, that's a really key event that we need to consider here. We need to look and see, okay, was there a noticeable jump in the stock price or the trading volume around that time? Was it a big deal when those index funds had to go out and buy all those shares? And it might also be worth looking at, any past instances of ARWR being added to or removed from other indices. Did anything interesting happen then? And then looking ahead, the Russell indices are actually moving to semi-annual rebalancing starting in late 2026. So that's going to be another set of dates that we want to keep an eye on.
So it sounds like all of these calendar-related events, they could definitely be exerting some influence on the stock price. But how do they compare to the impact of the more fundamental news? So things like earnings reports, clinical trial results, those big partnership announcements, how much do those things matter?
Right, but that's the key comparison here. Because these calendar effects, they might cause these kind of predictable little ripples in the stock price. But those ripples are often pretty small. And it's really fundamental news that tends to generate the much larger and more immediate waves, if you will. So when ARWR releases, its quarterly earnings, or it announces, some really significant data from one of its clinical trials, or, maybe it enters into a major collaboration agreement with another company, those are the events that typically trigger much bigger reactions in both price and trading volume. I even see here a note that ARWR's stock price actually declined quite a bit after one of its recent earnings reports. So that's a great example of how, the direct company-specific news, it often overshadows any of those underlying pressures related to the financial calendar. And, similarly, if there's big news that affects the entire biotech sector, that can have a huge impact on ARWR too, sometimes even pushing the stock to a new low for the year. And it doesn't seem to matter, where we are in the monthly or quarterly cycle when those big news events happen.
So it sounds like the calendar might be providing a little bit of background hum, but the real story is probably unfolding somewhere else. So let's shift gears here a little bit and talk about something you mentioned earlier, ARWR's unique approach to funding its operations. So the CEO, Chris Anzalone, he seems to really prefer securing those big deals with these huge pharmaceutical companies, names like Amgen, Janssen, Takeda, Sarepta, rather than doing those more traditional public offerings that are managed by investment banks. So tell me, why is that preference such a significant factor to consider here?
Well, Anzalone's strategy, it definitely has some advantages, especially for the company's existing long-term shareholders.
Yeah.
So by getting these big upfront payments and, agreeing to future milestone payments through these partnerships, Arrowhead is able to bring in a lot of capital without actually having to issue new shares of stock. And that's key. Because when a company issues new shares in a secondary offering, it dilutes the ownership stake of the current investors. So basically everyone's piece of the pie gets a little bit smaller.
Yeah.
But by doing these partnerships, Arrowhead is able to avoid that dilution. It helps them maintain a more stable share structure, which, a lot of investors really like.
I get that. But there has to be a potential downside here, right? There's no such thing as a free lunch.
Exactly.
And the downside here is that this funding model basically cuts out the traditional role of the investment banks, because those banks, they make a huge chunk of their money by underwriting stock offerings and managing all these other capital market transactions. So by mainly choosing this partnership route, Arrowhead is essentially saying no thanks to a potential revenue stream for those financial institutions. This leads to a really interesting theory. So the theory is this: could all this persistent price pressure and the pretty high level of short interest that we've seen in ARWR, could it be at least partly a result of institutional dissatisfaction with this kind of unusual funding approach? Is it possible that because these big banks aren't getting those underwriting fees from Arrowhead, that they're maybe, a little bit less inclined to cover the stock with their analysts? And if the analysts aren't talking about the stock as much, well, then maybe that could dampen investor enthusiasm. And that could make the stock more vulnerable to, negative sentiment or even more aggressive tactics like short attacks.
So the idea here is that Wall Street might not be super thrilled about a successful biotech company that isn't, throwing them those big underwriting fees. Yeah, it's definitely an interesting theory. Food for thought, for sure. But here's the thing that really gets me. This whole idea of potential pushback from Wall Street, it seems to kind of clash with what we're seeing in terms of institutional ownership, because our data shows that institutional ownership in ARWR, it's actually been going up pretty steadily too, from mid-2020 to early 2025. And there's an even bigger jump starting in like mid-2023, which kind of coincides with some of those positive developments we were talking about earlier, within the company. So if there really was some, coordinated effort from parts of Wall Street to put pressure on this stock, wouldn't we be seeing those institutions selling off their shares? Shouldn't they be heading for the exits if they're unhappy with how the company's being run? It doesn't really add up.
You're right. That is the central puzzle here. Because typically when you see increasing institutional ownership that's interpreted as a positive sign, it means those big, sophisticated investors, they have confidence in the company's future. And it can often act as a kind of buffer against, excessive downward pressure from short selling. But with ARWR, we're seeing this increase in institutional ownership happening at the same time that the stock price is all over the place. And on top of that, there's still a really significant level of short interest. Some reports are saying it's around 10 million shares as of late 2024. And this is all happening while institutional ownership is estimated to be somewhere between 62% and over 71%, depending on which source you're looking at. So it's a real head scratcher.
So if these institutions, they collectively own such a big chunk of the company, where are all the shares that are being shorted coming from? Who's lending these shares out?
That's the million-dollar question, isn't it? So even with a lot of institutional ownership, there are still ways for hedge funds and other short sellers to borrow shares. And one of the main ways is through institutional lending. So it's entirely possible that other investment funds, or even some of the very same institutions that own ARWR shares, they might be lending out a portion of their holdings to those short sellers. And of course, they're getting a fee in return. It's just a way for them to generate a little bit of extra income. And then you've also got shares coming from retail brokerage accounts. So a lot of those retail brokerages, they have these securities lending programs. And what that means is individual investors who have accounts there, they can allow their shares to be lent out. And then lastly, you've got the market makers. They play a crucial role in just making sure that trading can happen smoothly and that there's enough liquidity in the market. And as part of their market-making activities, they often engage in short selling themselves. It's just part of how they make sure there are always buyers and sellers for a particular stock.
So the point here is that just because a large percentage of a company is owned by big institutions, it doesn't automatically mean that all those shares are, locked away in a vault somewhere and completely unavailable for borrowing.
So even with high institutional ownership, there's still plenty of supply of shares for those who want to short the stock. All right, so let's dig into this a little bit more. How do these hedge funds like AQR Capital, how do they actually exert downward pressure on a stock like ARWR? What's their playbook, and what are they trying to gain from all this?
All right, so this is where we get into some more active and, in some cases, pretty aggressive trading strategies. So short selling, that's a pretty fundamental tool for a lot of hedge funds. And the way it works is this. A hedge fund borrows a certain number of shares. They sell those shares on the open market. And they do this with the hope that they'll be able to buy those same shares back at a lower price in the future. And if they can do that, they pocket the difference as profit. Pretty simple idea, right? But here's the thing. When a lot of shares are shorted, that increases the supply of the stock that's available in the market. And when supply goes up, well, price tends to go down. So that's one way that short selling can put downward pressure on a stock. And then on top of that, if other investors see that the stock price is falling all same, sometimes that can trigger even more selling. And in some cases, they can even turn into a bit of a panic. And then you throw in all these algorithmic trading systems, which firms like AQR, they use these algorithms in a big way. And these algorithms are designed to detect those initial price drops. And then they automatically increase the selling pressure.
So it's like they're pouring gasoline on a fire. And that can really accelerate that downward trend in the stock price.
And it's not just directly shorting the stock itself, right? I mean, they can also use options to kind of get against the company.
Yeah, exactly. So one really common way to speculate that a stock price is going to fall is to buy put options. And a put option gives the holder the right, but not the obligation to sell a stock at a specific price by a specific date. So if the stock price actually does go down, well, those put options, they become more valuable. And what's really interesting here is that the market makers, the firms that typically sell those put options, they often engage in a hedging strategy to protect themselves. So to make sure that they don't lose a ton of money if the stock price actually does tank, they'll often short the underlying stock at the same time that they sell those put options. So it's like a little side bet they're making. And that hedging activity can itself contribute to that downward pressure on the stock price. It's like this kind of constant low-level selling pressure that's always there in the background. So yeah, when big players bet against a stock using options, the firms that sell them those options, they often end up kind of quietly betting against the stock in the regular market too, just to protect themselves. And it can really add up over time.
And then you've got those momentum-based algorithmic trading strategies. Those can really kick in once the stock starts trending down, right?
Yeah, for sure. So these algorithms, they're specifically designed to spot and then capitalize on existing price trends. So if ARWR stock price starts to drop, these algorithms, they can automatically increase their short positions. It's like they're jumping on the bandwagon and just riding that negative momentum all the way down. And some of these algorithms, they're even programmed to take advantage of those stop loss orders that a lot of investors use. So a stop loss order basically says, look, if the stock drops to this specific price, just sell my shares automatically. And the idea there is to limit your losses. But what can happen is when the stock hits that stop loss price, a bunch of those orders get triggered and all those shares get dumped on the market all at once. And the momentum algorithms, they're right there ready to pounce. They see that flood of selling and they just increase their short positions even more. And it's worth pointing out here that biotech stocks with their inherent volatility, these stocks live and die by news about clinical trials and regulatory approvals. They can be really vulnerable to these types of trading tactics.
Because the news flow can be so unpredictable, it's easy to spook investors and get those algorithms piling on.
So in a way, it almost sounds like they're trying to create the very price decline that they're betting on. Is there any chance that they might also try to influence, the narrative surrounding a company or even the broader biotech sector, like trying to get people talking negatively about the company?
It's definitely possible. Really hard to prove definitively, but the potential is always there for sophisticated market participants to try to, sway sentiment in their favor. So this could involve, working behind the scenes with analysts or media outlets to push a more negative outlook on a particular company, or maybe even on the entire biotech industry. They might try to emphasize the potential risks or downplay the positive developments. And then, of course, in today's world, you can't forget about social media. Using platforms like Twitter to spread a certain narrative, that's a real possibility too.
Yeah.
And it could even involve, automated accounts or influential traders kind of pushing that narrative. So, yeah, it's something we can't completely dismiss.
Okay, so I get how they create this downward pressure. But how do these hedge funds actually profit from all of this? What's their end game?
Well, the most straightforward way they make money is through those short positions and through their put options. So if the stock price drops like they predicted, they can buy back all those shares that they initially shorted at that lower price, and they pocket the difference. Simple as that. And their put options, well, those become more valuable too as the stock price goes down. So they can sell those options for a profit as well. And then they can also potentially profit from moves in the broader market. So let's say they think the entire biotech sector is headed for a downturn. They might short a bunch of different biotech stocks, or they might short an exchange-traded fund that's focused on the biotech sector. So they're not just betting on one specific company, they're betting against the entire industry. And then, of course, after stock has dropped a lot, they might decide to cover their short positions, buy back all those shares at a much lower price. Or they might even do the opposite. They might start buying shares at that lower price because now they think the stock is actually undervalued, and they think it's poised for a rebound.
So it's all about timing the market and trying to predict what's going to happen next.
So it sounds like this could theoretically just go on forever. These hedge funds just keep shorting the stock, driving the price down, and making money along the way. But our information actually suggests that this kind of sustained downward pressure, it can't last forever. So what are some of the things that might limit these strategies? What are the risks for these hedge funds?
Yeah, that's a great point. Because there are a few natural checks and balances in the market, things that can kind of put a stop to this sort of thing. And probably the biggest risk for a short seller is something called a short squeeze. So basically what happens is if there's some unexpectedly good news about the company, or maybe there's a sudden surge in buying interest for whatever reason, well, those short sellers, they might be forced to very quickly buy back all those shares that they shorted to make sure that their losses don't get too big. And when all those short sellers are rushing to buy back shares at the same time, that can create this huge surge in demand. And that can send the stock price skyrocketing, which is really bad news for the short sellers. And then you've also got regulatory scrutiny. So if regulators think that there's some illegal activity going on,
things like naked short selling, which is where you sell shares without actually borrowing them first, or just straight up market manipulation. Well, they can step in and start investigations. They can hand out some pretty hefty penalties.
And then, at a certain point, if a stock price just keeps falling and falling, it might reach a level where long-term value investors, they look at it and they say, hey, you know what? This company's actually really solid. They've got good fundamentals. And the stock is just way too cheap right now. So they might start buying up a lot of shares. And that new buying pressure can help to stabilize the price and eventually even reverse that downward trend. And then you also have things like market-wide circuit breakers. So if the market gets too volatile, if prices are swinging all over the place, those circuit breakers, they can actually halt trading for a little while, just to give everyone a chance to kind of catch their breath and prevent things from getting too crazy. And then in some cases, the brokerage firms themselves, they might actually step in and say, hey, you know what? The short interest on this stock is just getting too high. It's too risky. So they might put limits on how much people can short sell the stock.
So there are definitely things that can push back against this kind of relentless downward pressure. So for those investors who might be, feeling a little bit helpless right now, maybe they own shares of ARWR and they're wondering, what can I actually do to fight back against these hedge funds and these high frequency trading algorithms? Are there any strategies that they could use to kind of protect themselves?
Yeah, there are a few things that long-term investors might consider. So one pretty important approach is to try to increase their own ownership of the stock and to reduce the overall number of shares that are actually available for trading, they call the float. So a bigger chunk of those shares is held by committed long-term investors and fewer are kind of floating around out there in the market. Well, that makes it a lot harder for short sellers to borrow shares. It makes it harder for those high-frequency trading algorithms to find those, easy exploitable trading opportunities. So how do you do that? Well, individual investors can hold their shares in cash accounts instead of margin accounts. Because when you use a margin account, you're basically borrowing money from your broker to buy those shares. And that often gives the broker the right to lend out your shares to short sellers. But if you hold your shares in a cash account, the broker can't do that. And then you also have, bigger investors who really believe in the company's long-term potential. They can strategically buy up more shares. And the company itself can actually buy back its own shares too, which reduces the number of shares that are out there in the market. And then sometimes you'll see groups of investors kind of coordinating their buying activity. And that can trigger those short squeezes that we were talking about earlier. And it's also really important to kind of keep an eye on what's happening in those dark pools, those private exchanges where a lot of big trades happen, and to scrutinize those failure to deliver reports. Because sometimes those reports can be a sign that there's some naked short selling going on. And even just buying call options that can create some upward pressure on the stock price. Because when investors buy call options, the market makers who sell those options, they often have to buy shares of the underlying stock to hedge their own positions. And then, of course, if you suspect that there's some manipulative trading going on, you can always report it to the regulators. Let them know what you're seeing and let them investigate.
So those are some good options. But it's interesting, though, because we said earlier that ARWR, it already has a pretty high level of institutional ownership. But it hasn't totally stopped this short selling and high frequency trading pressure. So why do you think that is?
Yeah, we talked about this before. It all comes down to securities lending. Even if a big percentage of a company's stock is owned by institutions, those institutions can still decide to lend out their shares to short sellers. And they do this to earn a fee. So even though the overall ownership might be pretty concentrated, there's still this steady supply of shares available for borrowing because those institutions are happy to lend them out and make a little extra money. So unfortunately, high institutional ownership, it doesn't automatically mean that short selling is going to go away.
Okay, so let's try to tie all of this together. We've covered a lot of ground here.
Yeah.
What's your overall take on why Arrowhead Pharmaceuticals seems to face this persistent downward pressure on its stock price, even with all this good news and even with all these big institutions buying up shares? It doesn't seem to make sense.
Right. It is a real head scratcher. And I think it comes down to a few key factors. So first of all, there's a pretty strong argument to be made that the CEO's decision to go this partnership route for funding, while it might be good for long-term shareholders because it prevents dilution, might also be rubbing some of those traditional Wall Street players the wrong way, because those are the players who would normally be making a lot of money by underwriting those big public stock offerings. So maybe there's some resentment there. Maybe some of those institutions are just not as enthusiastic about ARWR because they're not getting a piece of the pie. And that could translate into, less favorable coverage from analysts. or maybe even a greater willingness to bet against the stock or to profit from all this volatility. And then, of course, there's the fact that there's just a ton of short selling going on. And all those high-frequency trading algorithms, they're always looking for an edge. So even when there's good news about the company, those short sellers and those algorithms, they can jump in and try to push the price down. Maybe they think the stock is still overvalued.
Or maybe they see some risks that other investors aren't seeing. And it's hard to say for sure, but it is possible that there's some coordination going on. Maybe some of these big players, they're working together to manipulate the stock price. It's really hard to prove, but the fact that we keep seeing this pattern, good news followed by downward pressure, it definitely raises some eyebrows. So in the end, it seems like the benefits of that non-dilutive funding, which is supposed to be a good thing for the stock price, well, those benefits, they seem to be constantly getting wiped out by these other external market forces. It's this tug of war between the company and the market.
So as we wrap up this deep dive into Arrowhead Pharmaceuticals, I think we've learned a lot. Those predictable rhythms of the financial calendar, they might have some impact. But the real story seems to be this tension between how the company is choosing to fund itself and, the interests of some of those powerful players on Wall Street. And that tension, well, it might be contributing to this downward pressure that we're seeing. And then on top of that, you've got the short sellers and the high-frequency traders. They're always lurking in the shadows, ready to pounce on any opportunity to make a quick profit. So it's a really fascinating situation, a real puzzle. You've got this company with a lot of potential, but the stock price just doesn't seem to reflect that. And there are a lot of different forces at play here. It's not just about the fundamentals. You got to understand the market dynamics, too.
Absolutely. And I think you're right. It's a puzzle, but it's a puzzle that's worth trying to solve. Because if you can understand how these different forces are interacting, you can make better decisions as an investor.
And that leaves us with one final question to ponder. Will Arrowhead's long-term success, will that be enough to break free from this cycle of price pressure? Will they eventually prove the doubters wrong? Or will those external market forces continue to hold the stock back no matter how well the company does? It's a question that only time will answer, but it's definitely something to keep a close eye on. Thanks for joining us for this deep dive.